Silver this morning because silver is doing really well. We're above $60 in the spot. Right now, as I speak here, it's 7:20 a.m. London time. We're at 61.50. The high's been 61.63. And why would this help? Well, this would not just help the United States, it would help the whole world. Some posts on X that are calling for 10,000 gold and $200 silver, which would be 50 to 1.
Manco 64 reveals layered gold revaluation thesis. U.S. Treasury could revalue gold from $422 to $4,222 100 times, creating $1 trillion free money without borrowing. First layer likely before July 2026, when Judy Shelton's gold-backed trust bond may launch. 10,000 gold dollars, 200 silver dollars now conservative. Silver above $60. Gold-silver ratio breaking down. Bond markets collapsing worldwide. Japan intervening daily. $70 trillion corporate debt maturing 2026 to 2027 will trigger haircuts, chalked bail-ins. Stackers must act like central banks, keep stacking calmly. Historical precedent: 1972 to 1973 layered revaluation, 35 to 38 to 422. Gold revaluation helps all central banks manage debt, creates inflation most won't see coming. Positioning now critical. Subscribe to Fine Metals for future updates.
The gold-silver ratio has broken down definitively. Of course, that's good for silver. There's still a lot of room, of course, on the downside. When the market is not going our way, when we're seeing a big correction, and also vice versa, where we're now, try to keep an even keel. Don't get too cocky. And the bond market is in trouble, not just the U.S. Treasury market and, for example, the Japanese government bond market, but also corporate bonds all around the world. Long-term yields are headed higher everywhere around the world. It's not just the long-term bonds now as well. It's the short-term bonds, 1 to 3 years. All that gold is still valued at the statutory price of $42.22. That was set in 1973. In 1972, they had set a statutory price of 38. Prior to that, it was 35. That price was set in January of 1934, 35. So yeah, they did it in 72 from 35 to 38, and then from 38 to 42.22 in 73. And by the time they did those, the market price of gold was already a lot higher. It was like at 85 or 100. Well, today we're going to look at gold revaluation and why I think it's going to be a must for the United States. Once they reset that price or revalue that price will be the floor for gold. So gold has never gone back below 42.22 since 1973. They could revalue it to around 4,000 or even 4,222, which would be 100 times the current price. That would give Treasury around $1 trillion of spare cash that wasn't borrowed into existence. It would give them 1,000 billion, yeah, or $1 trillion to work with. So I see that as probably the first revaluation, but that would send a huge signal to the market. In gold, the market price would probably be around 5 or 6 already. And then they could do another revaluation in a year or two to 7, and then another one to, let's say, 12. It could be worldwide about $70 trillion worth of bonds all kinds of bonds, right, that are due for, that are going to mature and are due to be rolled over. Corporate debt is going to be in trouble. We're already seeing private equity and private credit in trouble. They're going to change the terms of these bonds, the corporations, in order not to default. It's akin to a bail-in, as Judy Shelton has proposed. If we have a gold-backed treasury note or bond, she calls it the trust bond, she'd want to have the first issue on July 4th, 2026, a bit of a symbolic, let's say, thing to do, seeing that it's the 250th anniversary of the signing of the Declaration of Independence. The Fed, but also other central banks around the world, to basically be able to carry the debt that they have on their balance sheets more easily. It will allow governments as well. You need to act like the central banks. You need to keep adding on to your stacks, both gold and silver. We could see something to that effect before July next year. You're not making money, you're making currency, a currency that's becoming worth less and less. And therein lies the reason also for this revaluation. Gold is going to go ballistic once that happens. Those two numbers are very realistic, and they might not be enough eventually once you listen to my layered revaluation idea and speculation, just what I'm thinking they might do. The BOJ intervene again. Our friend Dario, who I had on yesterday, he posted this morning, Takaichi might be panicking, that's the prime minister, but surely the BOJ got her back. Still, 800 billion yen intervention today. Notice how banks wanted to sell 4 times the amount of 1 and 3 year JGB to the BOJ that the BOJ offered to purchase. The total number of interventions since July has risen to 156. And I can bet the Exchange Stabilization Fund in the US is probably doing the same, intervening in the bond market. So is the Exchange Equalization Account or Fund. Well, central banks are buying silver now. And you have to do it in a calm, rational fashion, i.e. dollar cost average, or whenever you can add on to it. Don't do it with the emotion of greed, of thinking that you need to make money. Corporate bonds are like the plague, I think. And even government bonds, they might stay steady. They might do QE to buy them like the Bank of Japan is doing. But in real terms, in terms of gold and silver, they're going to lose a lot of value. And I'm not saying you should have 100% in gold, silver, and the miners, but you need to think about having it as insurance for your overall portfolio. And you might want to get rid of a lot of other stuff, but that's up to you. The first revaluation will just be a signal, a forward guidance. That's what I meant. But some people might think, well, if they revalue it to 4,222, that's very low. I want it higher, but don't forget, that's going to act as a floor for gold. Yes, the Treasury could even take that windfall. Let's say they do it to 7,000 or 8,000. They would have an extra trillion, and so on and so forth. They could retire a lot of Treasury debt. They could keep some of it to spend. Yeah, just like we would if we sold some of our gold. We'd pay off some debt, right? We would spend some of that. We would hopefully also invest some of that. And yeah, that's how I see it, a layered revaluation. I think it's possible. I think it could happen. The first one could happen, or the first two. I don't know. I'm just like speculating here. We could see something to that effect before July next year. People related to the Trump administration, like Scott Bessent, who's a gold bug, he spoke in an interview in November, even before the election, even before he even knew he was going to be Secretary of the Treasury, that he sees a global monetary realignment akin to the Bretton Woods, let's say, agreement in 1944. Then you have Stephen Mirren. I think he's the head of the Council of Economic Advisors. He's become a Fed governor. He's looking for devaluation of the dollar. Yes, the Federal Reserve, even the Federal Reserve has published a paper in August by Colin Weiss about revaluation. It looked at international revaluations like they did in Italy and Germany, I think, in the late 90s, and how it would work. And we've been through all this. And of course, the statutory price at which the Treasury's 8,133 metric tons of gold, and yes, the audit hasn't been done, but I think the market accepts that amount, at least the vast majority of people. And I think we will see an audit. And who knows, they might even be adding on to that. We will see inflation. That's the other thing. They want to inflate, and most people won't see it coming. And that's why hopefully you are in a good position to protect yourself financially. And I don't think it's, of course, too late at all to buy gold and silver, the P word. But suffice it to say, central banks crushed short-term rates, artificially lower to zero or even negative, and longer-term yields as well went down massively, not just government bond yields, but also corporate bonds. There was like the spread came in, and it was probably, I don't have the numbers, but there's a massive amount of borrowing, not just by the governments, but also by corporations and by individuals. And a lot of this borrowing was done on a 5-year basis, i.e. there were 5-year bonds or notes or loans. So if you add, let's say 2021, when it was at the peak of this, if you add 5 years to that, you get 2026.